Has the Japanese economy already successfully emerged from recession and begun its path toward recovery? Or is it just steadily moving toward the edge of a new cliff? Is anyone here investing in Japanese stocks? Wait a second. Hello, this is Sai from Money Monster. Thanks for watching. So, is anyone investing in Japanese stocks, or maybe keeping an eye on the economy, trading yen, or getting ready for a trip to Japan? There's gotta be someone, right? Otherwise, you probably wouldn't be watching. But hey, just watch anyway for fun. Today, I want to talk about the Japanese economy because recently, Japan has officially come out of recession. Japan's GDP has gone up from negative territory and is now in the positive at 0.4%. What's really important is that Japan has also officially escaped deflation. Japan has been stuck in deflation for a really long time, but now it's officially out of it because the inflation rate has risen to 2.8%. That's even higher than what the BOJ, or the Bank of Japan, had predicted. And another key point is Japanese wages. It's gone up to 5%. Actually more than 5%, even higher than that. And you might say, hey, wages went up 5%? Last year, my wages almost went up by 10%. People might think 5% isn't much. Thais think it's not much, foreigners think it's not much, Americans think it's not much. But for Japanese people, a 5% increase is huge. That 5% is actually the highest wage increase rate in decades. Over the past 30 years, this has happened because Japan raised its interest rate, the highest rate hike in 17 years. That means inflation is now official, and it's now possible to officially raise the prices of goods and officially increase wages as well. But let me tell you something about Japanese salaries and the deflation that's been going on for so long. It's a gradual process, but I don't think it's that hard to understand. Japan just raised its interest rate for the first time in 17 years. Isn't that right? That means Japan has actually relied on a negative interest rate economy for an incredibly long time. This is the first rate hike in 17 years, going from a negative 0.1% up to a positive 0.1%. So what about Japanese wages during all this time? Even though interest rates were negative, negative interest rates mean the government wants to encourage people to take their money out and spend it. They don't want people to just deposit their money in the bank. But what actually happened is that Japanese people kept putting their money in the bank and didn't take it out to spend it all. If you look at this number, the PMI, which measures industrial production, the black line pointing downward here, shows the lowest PMI in the past 3 years. And this is despite the fact that interest rates were already negative before this. That's it. People still aren't spending. They choose to put their money in the bank instead, even though the more they deposit, the more it decreases because it's a negative interest rate. You get what I mean? People just aren't spending. Now the interest rate has gone up to 0.1%. It might not seem like much to us, but I think it's a big deal for Japanese people since it's been negative for so long. We'll have to see whether Japanese people will finally take their money out to spend or if they'll keep leaving it in the bank. If people still refuse to spend their money, the PMI will keep dropping. When the PMI goes down, it means manufacturing companies are producing less. They're producing less because people aren't buying, what we call in technical terms, low demand. So then I started thinking, hey, when it comes to Japan's economic numbers, whether it's GDP, inflation, or wages, they're all going up. All the numbers look great. But you have to wonder, are these numbers just too good to be true? Is it like Beauty and the Genie? Meaning, is it just magic, not real? Because if the economic numbers are really that good, the yen should be getting stronger. But on the day they announced the policy interest rate hike, the yen actually dropped hard. It went from about 149 yen per US dollar to over 151 yen per US dollar. That's a really sharp drop. Why did that happen? It's because some investors saw through the game. They just don't trust the BOJ or the Bank of Japan. The fact that Japan raised interest rates for the first time in 17 years means that the Japanese economy has been relying on a negative interest rate system. And who benefits from negative interest rates? It's good for people who are in debt. And the Japanese government actually has the highest public debt in the world, up to 264% of its GDP. To put it simply, it's like if you earned 1 million baht, but you owed 2,640,000 baht. That's not healthy at all. You just can't pay it off. So if the interest rate goes up, even if your debt stays the same, higher interest means your debt increases. And if the Japanese government's debt increases, then publicly listed companies in Japan will also see their debt go up. Right now, it's still okay because the interest rate has only gone up to about plus 0.1%, let's say. But if the BOJ gets more aggressive and raises the interest rate to, say, 1%, the amount of debt held by these listed companies, which have been issuing corporate bonds like crazy, will be affected. Just last year, in 2023 alone, publicly listed companies have already issued 17 trillion yen in corporate bonds. If the interest rate rises from 0.1 to, say, 1%, the amount of debt for these companies could increase 2 to 3 times. This would be a real shock. Any company whose earnings aren't strong enough and has to rely heavily on borrowing, like those so-called zombie companies, would basically get pushed off a cliff all at once. And in Japan, there are about 250,000 companies, and 27.1% of them have already become zombie companies. That means if the interest rate is raised too aggressively, those 27.1% zombie companies would basically get pushed off the cliff all at once. As for Japan's public debt, which is 264% of GDP, do you know what most of it is? It's mainly Japanese government bonds that have been issued and sold. And do you know who buys most of Japan's debt? It's the BOJ. The Bank of Japan itself is the biggest buyer of Japanese government bonds, holding as much as 53%. The reason they have to step in and buy is because they don't want borrowing costs and interest rates to get too high. They want to keep things under control. Most of the money borrowed is used for social welfare and education. Healthcare for the Japanese people. If they didn't have it, things would be really bad. And even though the policy interest rate has gone up for the first time in 17 years, the BOJ still announced that it will keep buying the same amount of government bonds, 6 trillion yen per month. Even though interest rates are rising, which means the amount of debt that needs to be repaid will also increase, they're sticking to that amount. So what does this actually mean? Essentially, this means that the balance sheet, the actual numbers in the Bank of Japan's accounts, will gradually go further and further into the red. Fitch Ratings actually ran a scenario showing that if the Japanese government continues raising interest rates, the Bank of Japan's account balances will keep going negative. It's possible that by 2027, the deficit could reach as much as minus 12% of Japan's GDP, which is an incredibly significant amount. And some people might ask, hey, with the account balance being this much in the red, is Japan's economy going to collapse? Is Japan going to fall apart? Let me tell you, just because the account balance is negative or whatever, it doesn't mean Japan's economy is going to crash. But what it does do is make Japan's economic image look bad. It gives off a bad vibe, and it immediately affects investor confidence. Investors just won't trust it. That's the bottom line. This will also hurt Japan's credit rating, and that will have an impact on Japanese assets like government bonds and the yen. They'll lose value, they'll depreciate. And if Japan ends up with a huge amount of debt, but the country's economy isn't doing that well and can't generate enough money to pay off the debt efficiently, what can they do? The classic ways to pay off debt are, first, printing money, but printing too much money is really bad. It's terrible for financial health. There's never been a time in history when printing money didn't have to be paid back. There's no such thing as free money printing in this world. It's never happened in history. Sooner or later, it always has to be repaid. The second way to pay off debt is by borrowing. If borrowing domestically isn't enough, then you have to borrow from abroad. But believe it or not, Japan's credit rating, compared to the group of 7 countries, is ranked second. In the end, it's just barely above Italy, and actually, it's even lower than the UK. That means if Japan has to borrow money from abroad, it'll have to pay high interest rates. All of this explains why, even though Japan's GDP is good, inflation is up, and wages are rising, the yen can still drop so sharply. And if you ask what would happen if they raise interest rates and keep following this policy, what will we see? Who wins and who loses? Let's take a look. If interest rates go up with this policy, we can divide people into winners and losers. Let's start with the losers. Do you know who the first losers are? Thai people. Hey, how are we involved? Well, it's Thai people and foreign tourists who want to travel to Europe. Thai people and foreign tourists who want to visit Japan, because when interest rates go up and inflation rises, the prices of goods and services will also increase. So your trip to Japan will get more expensive. The second group that loses out is the government, because the Japanese government, which has public debt amounting to 264% of GDP, about $8 trillion, will see its debt burden rise if interest rates go up. The third group that will lose out, which I've already mentioned, are the publicly listed companies and various other companies in Japan. That's because they've issued a huge amount of corporate bonds. If the government's debt increases due to rising interest rates, these companies will also see their debt rise for the same reason. The fourth group that loses out are Japanese people who run export businesses or anything related to exports. If, for example, policies change and the yen strengthens, then if the yen appreciates, when the currency gets stronger, it's like just sitting there, and suddenly our export goods become more expensive. So we lose some of our competitiveness. And Japan's competitors are pretty formidable too, because Japan's direct competitor is China. These two countries both rely on the same thing for their economies: manufacturing and exporting industrial goods. Think of made in Japan, it's synonymous with high quality. So you might expect them to be a bit pricey. China used to compete only on price with lower quality, but now brands like Xiaomi are producing really excellent products nowadays. If a stronger yen makes Japanese goods even more expensive, Japan could end up losing this entire competitive battlefield to China quite badly. So who are the winners? Who benefits when the exchange rate goes up? The first group is Japanese consumers. Because if interest rates go up and the yen strengthens, they'll be able to import things like food and energy at lower prices. So food and energy in Japan will become cheaper, which is good for consumers. The second group that benefits in Japan is banks, investment firms, and wealth management companies, because they'll be able to lend at higher interest rates. And finally, Japanese people who love to travel also benefit. Japanese people who want to travel abroad, if the yen gets stronger, it'll be cheaper for them to travel overseas. So as Thais, we have a job to do. Our job is to invite Japanese tourists to come visit our country. This is Zirachai Masai from Thailand. See you again next time with Samani Motor. Thank you.